Hello my fellow freedom builders and welcome back to the channel. Now, as many of you know, I am active on Etoro. Just here in the last 2 months I have started up as a so-called popular investors that people can copy. And to be honest, we have started at a bit of a unfortunate time since we've had this dive in the market. But that leads me to make this video about how I approach my normal trading also when we have a drawdown. Because what is important is that we can keep our emotions in control when we are seeing the market going against us. And this is one of these times, and I'm very calm and very confident about this strategy because it is tested and I know exactly what to expect of it. So let's have a look at it. First of all, if we are looking at the Etoro, if you don't know Etoro, sorry, let's have it here. If you don't know Etoro, it is a platform. It is a trading broker basically, and they have this feature where people can copy you, and you have to go through some processes and some educational material and so on. But when you are approved there, people can copy you. And as you can see here, I was also going with my ETF strategies in 2019 and 20. These were extremely conservative strategies, so they didn't produce much results, even though they were in the positive. So we have developed some strategies that are a bit less conservative, and as you can see, they have started out with some minuses here. Now this was only, I think, 1 week or 1.5 weeks of January in these numbers. Then we have February here, and March is also in a minus. It looks very bleak and red here, but basically we're down around 5%, and with the losses yesterday, they are not included here. I think it is about 6%. Now, is this something I worry about? No, not really. Because I know my strategy, and that is one of the important things, both when you're investing just your own money, but also if some people are copying you. Because what you need is, you need a strategy that you are confident in using, also when you have the drawdowns, so you don't fall into the trap of trading from your emotions. That is pretty much the worst thing a trader can do. So let's see what I'm actually looking at when I'm evaluating a strategy like this. The strategy, I have shown it sometimes here. Now this is for the last 4 years. We have backtest back to 2012, but this is just to show you that in the last 4 years, you can see here from the spike here, we had some profit here, but as you can see the numbers in the bottom there, we are now at a drawdown of 7.7%. This is not outrageous, not at all. We have had drawdowns around 15% last year when we had the market crash. But what I'm looking at when I'm looking at a backtest is that I'm looking at, is this an abnormal drawdown? A drawdown somewhere between 5 and 8%, maybe a bit above. Is that without what can be or outside what can be expected? And no, it isn't. Let's see, we have the drawdown here. Then we had a couple of drawdowns here of 4 to 6, 7%. That was in the autumn last year. Of course, we had the big spike down here, but before that, we even had a 4% drawdown here. We had one here, one here. We have kind of a big double drawdown period here that actually lasted quite a while. Then we had a drawdown here, here, and here. You could also argue if this is just one drawdown, but there are some ups and downs in it here. We had a period with drawdown here, and we have some spikes downwards at the end here. Let's see if I can get that drawn somewhere here. So as you can see, just in this 4-year period, we have had at least 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, somewhere between 13, 15 times in 4 years, which actually means that what is to be expected of the model here, which is a combination of 4 different strategies, what can it be expected here is that somewhere between 2 to 4 times every year, you can expect a drawdown of 4 to 8%. And in the extreme case here, we have the 15%. This picture is the exact same if we are looking back to 2012, so I don't need to show you that. But it's just to show you that if you're looking at the drawdown graph down here, we are pretty much in a drawdown most of the time. So if you're looking here, you can see the date in the bottom in the little square down here. You can see that there's a drawdown period starting at the end of April 16, ending in July. So we have 2 or 3 months actually being in some sort of a drawdown here. You can see then we start a new drawdown period in August 16, which ends in February 17. So that is basically 6 months in a drawdown. We are slowly creeping up, and then we have a period here with making all-time highs a lot of times, but then we actually have a drawdown period here from January 18 and to August 18, and then a new one starts from September 18 going on to April 19. So as you can see, we are in a constant mode of drawdowns basically. And I've gotten a couple of questions from those of you that copy me saying, well, is this what can be expected? And yes, it is. If people are copying me and they can't stomach a drawdown of 6 to 8%, well, then I might not be the right one to copy. And I would say maybe that if you don't have enough ice in your stomach to really cope with a drawdown of 6 to 8%, you might even consider if the stock market is something you want to be in. And I'm not saying this in a condescending way, absolutely not at all. I'm just saying that I know that the last year or so have been a total complete bull uptrend without much dips whatsoever, no retracements almost. But basically the stock market is a volatile place to be. And if 6 to 8% is really scaring you, well, then you would have to consider if some sort of passive investment that where you just place your money and never look at it, if that is better. Now, what I did yesterday is that I actually put some extra money into my account. I found out that results in some of you getting a message from Etoro saying that you would have to put more money into your account. You don't have to do that. That is simply because I put money in, then Etoro took that as a sign that you would have to do that as well. You don't if you're copying me. But what I'm going to do is that next time we reallocate, and that is at the end of the month, then I'm putting more money in, because what I'm planning to do is that every time we have these drawdowns, somewhere between 4 and 8%, I will add money to the account, because as you can see, that is normally a good place to get in, where you get kind of a free uptrend from there. So that is at least my plan. Now, let me explain why this drawdown has occurred, because that is another thing that is important when you have a strategy. You have to know it well enough so that you know, well, this is a natural occurring drawdown, or maybe at some point you need to consider, is the model broken? Has something happened in the market that is so out of the normal procedure and structure in the market? Has the market structure simply changed so that I need to change my models? And I know every single bit of this model, and I can tell you that the reason we have a drawdown right now is that we are quite a lot exposed into the Nasdaq, the index, both with some normal QQQ ETFs and some triple, the TQQQ. Let me just get this adjusted here. And as you can see, the Nasdaq has pretty much dropped here. It has dropped something like 10-11%. And since I have been exposed to the Nasdaq, that has given me some of the loss. Then when we are investing in Nasdaq, we also have some hedges, meaning something that ought to be helping us in an upwards direction. When the market is going down, we normally see something else is going up. And what we normally see is going up is the bonds. And what we have seen in this case, let's just have the TLT, which is the long-term bonds here. As you can see, the overall bond market has also been going down quite a lot. That is because of an upwards pressure on the interest rates, and the question is, will Fed intervene and so on. Yesterday we saw a big spike down, a big drop down I should say, when Powell, the Fed chief, he went out and said, well, we are not going to do anything in the near future, and the market had kind of expected that. So the Treasury here, it dropped, and that of course could also be seen at once in the interest rates. Let's just have the 10-year yield here. You can see that that one has been exploding lately, going down a bit today, but it is absolutely in an area where I expect Fed to intervene at some point. But that's just to say that one of our hedges is the bond market, and right now we have seen both the Nasdaq drop and the bonds drop. Remember, this is not the bonds, this is the yield I'm showing you here, so that is the opposite of the bonds. The bond, the GLT you saw before, has been going down. Another hedge that we have in our model is the oil, and normally the oil is going down when the market is going down, or at least that is kind of, there's a good correlation between them. But lately, the oil has been exploding in price, and there have been several cases here, several reasons, and one of them is of course the weather in the United States. And we saw that there was a complete meltdown in the market in the United States, both because many of the production facilities simply halted the production due to the extreme cold weather, and then of course there was a lot of more demand for oil and gas and so on in the States, so that pushed the prices up. And we have the OPEC, or the OPEC Plus, that had a meeting yesterday, and people were expecting them to say that they would start producing a bit more. They took a production cut of 7 million barrels last year to push the prices up, and they have succeeded in that, you could say. But then it was expected for them to say, well, we're going to produce a bit more now. Many of the oil producing countries are very reliant on high oil prices, or at least selling oil to get to cover their fiscal budgets. And right now they are not cutting until April at least, or they are not releasing more oil until April. So that sent the oil up as well. So that is basically our three main moving parts in this strategy. We have some equity based, some index ETFs, and they're going down right now. Then we have some hedges, which is a lot of different bond ETFs. And we have the oil, which we are short in, I should say. So meaning that we want the oil to go down. And right now it is racing. So that is kind of a perfect storm right now hitting our strategy. And I would say that having a perfect storm hitting your strategy, and you're only down with something like 6 or 7%, that is definitely something I can live with. There is nothing in here that makes me shake on my hand and saying, oh no, this strategy is completely destroyed. I'm very confident in it. And that is both a message to you, of course, if you're copying me, but also if you're sitting at home with your own strategy and thinking, now, should I be worried about this? No one knows if we are going to have a complete crash in the market. Personally, I don't think we are, and there are a lot of cases in here. I do think that the overall vaccine programs getting rolled out, the overall getting the economy started again, will result in the stock market not having a complete crash right now. It might come later, actually it might come now as well, but then again, it is important that you have a strategy that hedges itself out and has some good fail-safes. And we do have this. Right now, we're just being hit by this so-called perfect storm in the market, and that will adjust. We'll also reallocate at the end of the month, so that normally tends to even things out. We can't see something here. When we look at the month-to-month results here, you can see that, for instance, last year, January here, then we took a hit in February and March. That was, of course, the big hit we had there. But actually, we were way down here. We were down 15% here, and I think it was March. But then the market evened out, and it tends to do. And then we reallocated here at the month's end. And all of a sudden, we were positioned to take all the upturn in the market, and we had some huge gains here in April, May, June and so on, and actually entered the year in something like, let's see, 41.5% here. So we actually had an extremely good year, even though we had the drawdown. So had we dropped the system, the strategies last year and said, oh no, we are down 10 or 15%, we would not have ended the year in such an amazing way here. You can see 19 was 26%. But we do have a losing year occasionally, and no strategy is completely immune to that. 2018 we had a 3% drop overall, and that is absolutely within the borders, the limits that we accept. As you can see right now, 6.3%, and the overall benchmark is up 0.8, but we are only at the beginning of March, so a lot of things can happen this year. That's all for now. I hope that gave you a bit of inspiration to how to look at statistics and how to keep calm, even though the market is a bit in a turmoil. Now, if you want to look more at Etoro, I put a link below, and that is a link where you're getting in on a landing page that is on a site called Invest Like a Guru, and that is the site that I have teamed up with these strategies here, and you can put in your email address and you will get some emails about how we are constructing this, and you're also being sent into an Etoro sign up page if you want to sign up to Etoro and have a go at following. I should say that right now, due to an extreme inflow of new customers, Etoro have increased the limits a bit. I think normally it's only a couple of $100 you need to open an account, but I think right now temporarily it is $1,000, and you need to have $500 to start copying a new popular investor in there. But I suspect that is going down at some point again. That's all for now. Remember to hit the like and notification bells and all that beneath down there, and take care of yourself and your money out there. I'll talk to you again shortly. Bye for now.